In March of 2023, the failure of three mid-sized U.S. regional banks sent the sector into a sharp downturn and forced action to stop a broader collapse. Regional banks have started to report some earnings this year. Let's talk about that and what we've seen so far with Alexander Yokum, Senior Vice President of Equity Research at CFRA. Thanks for joining us today.
Yeah, thanks for having me on.
How long do you think the 2023 scare left an impression, maybe deterred investors from putting money into regional banks?
Yeah, honestly, for several years, we had that regional bank crisis. And then after that, all eyes turned to commercial real estate. So there were some concerns there. We saw the not total collapse, but a significant drawdown in Flagstar. And then, investors started looking for issues across other regional banks, and they did find some. So 2022, 2023, 2024, a lot of these banks saw earnings contraction. It was really not until 2025 where we saw some improvement in sentiment, started to see a little bit of valuation improvement, but still, these banks are still well off where they could be in our view. Okay,
so what kind of year did they have last year when compared to the S&P?
Yeah, so they were a bit down comparatively. They were still up about 7% on the year on average, but there was some issues. So we had, of course, the tariffs really went into stage in April, and that ended up leading to loan growth underperformance. So we were hoping 2025 would be a strong year for loan growth, but the tariffs really stalled that out. Small businesses didn't really want to make decisions because they didn't know how tariffs were going to impact their businesses. So loan growth was quite weak. And then in the fall, we had some issues with credit quality. You may recall the bankruptcies of First Brands Tricolor. That sort of caused some issues with regional banks. Investors were concerned that that could spread, so they sold off regional banks. But at the time, we mentioned that we thought those were somewhat isolated. And positively, we haven't seen those credit concerns come up in the fourth quarter. That was more a third quarter incident, and we haven't seen it spread. So that's a real positive.
Okay, so on earnings so far this year, what are you seeing?
Yeah, so like I said, the real takeaway is credit quality, because that has been a concern for regional banks for a while now, and that has been improving. Commercial real estate losses have been coming down, and forward indicators are quite positive. When we look at guidance, generally speaking, management was guiding towards improved credit quality. Loan growth also, like I mentioned, was pretty weak last year, but it started to accelerate towards the end of the year, and it's looking like that's going to continue, especially in areas like businesses. Businesses are a little bit more optimistic. Obviously, there's been some geopolitical issues as of late, but if you actually look at areas like recession odds, they've been actually falling. So they started the year a little under 30% odds for the U.S. Now we're in the low 20s odds of a recession. So that's been improving as well. So net interest income is looking good with the loan growth. We also have sort of an interesting story where the regional banks have an advantage over the large banks in the sense that they underperformed previously, so the bar is easier for them to rise. So, for example, if you look at deposit costs, after Silicon Valley Bank, regional banks had to pay up for deposits. So that was a strain on their performance. But with interest rates coming down, that benefits them more than large banks, which didn't have that pressure. So they're positioned well to see margin expansion along with that loan growth should be nice for net interest income, which is, of course, their main source of revenue.
Okay, so let's talk about which of the regional banks you're liking right now and why.
Yeah, so our top pick, and it has been for a while now, is West Bancorp. So this is a smaller regional bank in California, but we really think they often, get criticized unfairly. So if we think about 2023 with Silicon Valley Bank, they really did sell off significantly because they are a California-based bank. But at the time, they actually put out a press release and their deposits did not fall. So while regional banks were seeing deposit outflows, that didn't occur for them. And that is because of their strong customer base. They do target Asian Americans. And because of that, they have a little bit of a niche and their customers are less likely to leave. Then, as you can see on this chart right here, during April, we had that tariff sell-off, and that was pretty significant. Because they do target Asian Americans, there was some concern that they might see some losses, especially because they deal a lot with Chinese customers. But we would point out that their actual exposure to loans outside of the U.S. is very little. And then if you actually look at their charge-offs, they didn't fall or they didn't get worse. They actually improved. So they got better and better. And then also there was a little bit of a fear around in the fall around these losses, these NDFI losses, and they didn't have issues there. So they've done quite well in terms of that. So each time there's a concern, they've actually outperformed the industry. And then if you look at terms of growth, their deposits, their loans, their revenue, and their earnings all outgrow the industry pretty much every year. And because, despite all of that, I would say their valuation is actually still somewhat depressed, just because there is always concern with the Asian American ties. But like I mentioned, their actual performance is almost all U.S. based, so we think that's usually overblown.
Okay, so that's East West Bank. Is there a second you do like at this point?
Yeah, so one I would like to point out would be Citizens Financial Group. So this is a bank which historically we were a little bit more neutral on, but more recently we've become more bullish. And why is that? You can see they've actually outperformed over the last year. So I mentioned regional banks generally underperformed. This is actually a bank that has outperformed. And the reason for that is they have now a competitive niche. You know, regional banking is very competitive, so we don't tend to like banks that are just kind of like all the other ones. We like the banks that have a competitive niche. And what they did is they actually picked up some wealth managers from the failed First Republic. And at the time, it was a bit of a tough look because you're sort of copying a failed bank. But we would point out that First Republic didn't fail because of its wealth. It failed because they had a large amount of uninsured deposits, which Citizens does not have that issue. And then they also failed because they had asset liability mismatch, which Citizens does not have that issue. So those two issues they don't have, but they do get the benefits. So they're building out this private bank, and this private bank is been pretty successful so far. So we've seen significant loan growth, significant deposit growth. AUM is increasing, and when you have that wealth, you can really get an expanded multiple, and we think that's likely to continue. And then we would also just mentioned that in terms of areas like loan growth, it's an area that they had previously struggled at, but it started to accelerate partly because of that private bank, but then also partly just because the economic environment has improved.
Alexander Yokum, got to leave it there. Thank you for joining us today. Appreciate it.